Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on with you.
And you have a brand new version of your book coming out soon.
Yeah,
where is it out now?
23rd, and it's got a red cover instead of a black cover, but I updated it with a bunch of research I did from the time that the first edition came out in 2015. So I had 3 years of experience in answering questions about the thesis, and there were a lot of things that I learned that I didn't know, especially about how the banking system works, how the central banks work, how the interest rates are managed or not managed, and what impact all of the debt will have on the real estate market. It's a worldwide phenomenon, and so I broadened it out a bit to other countries like Australia and Japan. And I think it'll be very helpful for people that are interested in learning more about that and figuring out what to do with the real estate. It's obvious that Canada is one of the most extreme examples of a housing/debt bubble, and there's about 5 or 6 countries in the world that are in that position, and Canada's ranked as the one with the highest risk of a financial crisis due to excessive debt, primarily backed by real estate.
What's that mean for the average Canadian? Is the price of their house going to fall? Are they going to lose their equity? Or if you're confident that you'll be able to pay your mortgage and carry on, you shouldn't worry about it?
Yeah, I think a lot of people have enough equity that even if they've owned for a while, they're sort of back. They bought back before 2009 or 10, somewhere in there. They obviously are going to be up, and even if prices drop 30 or 40%, they're still going to probably feel okay about their debt and their mortgage payments and that. But the ones that have bought more recently, especially with the minimum down payment of 5%, and in a lot of cases they were stretching, because prices had gotten so high, they were stretching to borrow the money maybe from the bank of mom and dad or whatever. And then that thing goes underwater by $100,000 or $200,000. They're going to be faced with a very difficult decision. Do they try and walk away from it and stop paying their mortgage? And in Canada, in most places, if you walk away from your mortgage, you can be pursued for the deficit. So then they're going to have to think about whether they declare personal bankruptcy or not. So there's a lot of issues. And one of the things I learned in the last 3 years is how widespread the belief is that real estate prices can only go up; they can never go down. It's such a strong belief, and so it'll be a shock to a lot of people. And of course, real estate prices are already dropping in West Van, in suburbs of Toronto, by 15-20% or more. So these are mostly the more expensive homes. In the more average-priced homes or condos, the prices in some areas are still rising. But it's really, if you look at the more expensive homes, that's where you see where the future trend is going to be, and that's looking very weak. So it's going to be one of those things that people, I guess, have to experience for themselves. You can tell people that it's happened before and it's likely to happen again, but until they experience it for themselves, sometimes they just won't believe it.
Also, too, of course, with perhaps a trade war with the U.S., the Commerce Bank did a study saying if all the steel and aluminum tariffs go in and other threatened U.S. Economic action, it could drop our economy 1.8%, which of course would be a recession and cost a lot of jobs. Does that mean a lot of people would also lose their homes?
I don't know what the direct implication is, but certainly one of the big things that would be worth looking at is if a bunch of tariffs go up all over. I mean, we've kind of gotten used to buying stuff from China and other places really cheap. You go on Amazon or whatever and you order it online and it comes and it's very inexpensive. And if some of those things go up in price because if we have to put tariffs on to retaliate against another country that's put tariffs on us, and some of the basic stuff that we buy that we have to buy gets more expensive, then we're going to have less money left over to buy what they call discretionary items. Discretionary items being, possibly restaurants or automobiles are considered discretionary. Some other things like that, and then of course in Canada, studies show through bankruptcy trustee people that people will do everything to hang on to their home, and so they'll cut out every other possible expense. So you might start seeing it first in things like auto sales, which have been way above trend line for several years now, and with massive loans that are being stretched out to 8-9 years even now, and so that's where you might start seeing it show up first. People get into trouble; they start cutting back on the so-called discretionary items.
Well, we've also seen television shows now where people who did take out 8 and 9 year loans, the car starts to fall apart after 5 or 6 years. It's no longer covered by warranty, so they have to go out and get a second car. So the two loans are combined, and they're now having to work 2 jobs just to pay off the loan. I
talked to a woman that worked at I don't know if she still works there. She was so unhappy. I think she may have quit, but she was working at a car dealer, and they were getting people in that were sort of like $20,000 or $30,000 underwater on their truck, but their truck was falling apart. This is Alberta, where it's mostly trucks, and so they needed a new truck. So they'd give them the loan to pay out. They'd covered the $20,000, and then they'd sell them a new car for $60,000. Now they got an $80,000 loan, and the interest rate is between 22% and 29%. And so I said to her, I said, well, who's doing that? Is it private lenders? And she said, no, the banks are doing it. All the banks are doing it. She mentioned one bank, but I won't mention the name because she said all the banks are doing it. So I was kind of shocked, and she was really not happy. Like, she just didn't like seeing people getting that deeply into debt. And obviously at 22%, they're never going to get out of debt. It's just like it's impossible. It's too big a burden to put on and especially now that the economy is slowing down a little bit. It's not, I guess in a period when wages were rising rapidly or something, you might be able to get it. But no, there's a lot of issues in that sector, and certainly a trade war is not going to help. Like, it doesn't affect BC and Alberta as much as it would Ontario, but it'll have impact all across Canada for sure.
We'll have more with Hilliard Macbeth right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, so what are Toronto and Vancouver condos doing right now, and are they contrary to single fixed-family homes?
Well, it's really interesting because the condo prices are still rising. In Toronto, the average condo price hit an all-time high just released today. But the inventory for sale has surged up to a record high level as well. So in Vancouver, I think the prices are still kind of leveling off, but the inventory is still very, very sparse. But in Toronto, one of the issues with these averages of prices is it depends on what buildings are coming on and what the prices are. I think what the developers have been able to do is they've been able to sell more and more luxurious buildings at higher and higher prices, and so it's not clear if it's an apples to apples comparison, but it doesn't actually make any sense when single-family homes are dropping in value. I mean, if somebody's going to pay $500,000 for a 345 square foot condo, and single-family homes that used to be $1.2 million have dropped down to $1 million or $900,000, they'd be way better off to just wait and save up their money and buy a single-family home because, as I know you and I've talked before, the only thing that really has value in the whole equation is the land. The building, whether it be a house or a condominium, it depreciates over time. Eventually it becomes very expensive to maintain or has to be torn down. So with the problem with condos is you don't get very much land. You know, somewhere between 10 and 15% of the initial purchase price of a condo goes towards the land, and the rest goes to the developer's profit, the advertising costs, the fancy gym and the pool and the concierge and all that stuff. So, you know, all that stuff, it's like driving a new car off the lot. As soon as you drive it off the lot, it's a lot of that stuff is gone. So you're not getting a very good bargain buying a condo compared to a single-family home. But, you know, maybe single-family homes are part of the problem, especially in areas with limited land like Vancouver, where even in Edmonton and Calgary, they're talking about trying to increase the density by having more people living in especially in these mature neighborhoods. Well, so I don't know exactly where it's going to go, but as an investment, a condo makes a terrible investment. It can be a great place to live. There's no question. You know, maintenance-free, carefree kind of thing. But if you're looking for a land investment, make sure that you buy land. Don't buy a building.
We'll have more with Hilliard Macbeth right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, the Canadian dollar is down to 75 cents U.S., the lowest it's been in a year. What's the prospect for the Canuck buck?
Well, it doesn't look good, in my opinion. Of course, forecasting currencies is always difficult, and a lot of people just don't even try. But Australian and Canadian dollars have been buoyed by the commodities resource boom for many, many years, and that seems to be somewhat over, especially if China slows down, as it is slowing down. So lower commodity prices. If Canada gets lumped in as a commodity currency, then 70 cents or even below 70 cents is not that far-fetched. It hit about 72 cents when the oil price dropped in 2014 after the initial OPEC failure to agree, and got propped back up when OPEC kind of patched together an oil bargain. You know, they were able to cut production and get the oil price back up a little bit, but in the long run, things like the breakdown of the NAFTA talks, the possibility of an all-out trade war, the lack of pipeline access to the world markets for Canadian oil, all those things are weighing on the Canadian dollar. And Canada did have a reputation as a safe haven currency, but I don't think that's it's weakening, and it probably won't be there a whole lot longer. Unfortunately, the U.S. dollar is really the only currency that seems to keep its safe haven status through all of the crises that come and go from time to time. Even when the U.S. is the instigator of a problem in the world, people still flock to the U.S. dollar. So it's quite interesting. There's quite a bit of angst in the emerging markets like Brazil and South Africa and that sort of thing right now, because they borrow a lot of money in U.S. dollars. Sometimes that's the only way they can borrow money. And it gets harder and harder to repay in U.S. dollars. And Canada's got that problem a bit, too. We have borrowed quite a bit of money in U.S. dollars, mostly in the private sector. And so if the Canadian dollar goes any lower, it's going to get tougher and tougher to repay that loan.
Oh, you were talking earlier before we went on the air about the yield curve. What's happening there, and what is it telling us?
So it's been 9 years since the last recession, and Canada had a fairly mild recession last time, actually. The U.S. had that was the global financial crisis, so we know how severe that was. And one of the most reliable indicators of the next recession, because there's always another recession somewhere down the road, is when the short-term rates are higher than or equal to the longer-term rates. So usually what the comparison is, the 2-year rate versus the 10-year rate. And any time it gets close, people start to watch it carefully. And it's gradually been moving to the point where it could invert. So in the U.S., is probably a better indicator than Canada. The spread is under 40 basis points, so less than half a 1% difference. And the reason why it's a telling indicator is that if people are willing to accept a lower interest rate on 10-year bonds, what that means is they're not expecting a really strong, robust economy. They're not expecting inflation to be strong. If they were expecting that, they would demand a much higher interest rate on a 10-year investment. So when the U.S. Federal Reserve and the Bank of Canada and the Bank of England are raising the short-term rates, which is the only rate that they control, and it ends up getting above the long-term rate, that's a classic forecast of a recession. So we're not quite there yet, but it's been moving steadily towards that inversion. And in the last 11 recessions, 10 of them, they've been preceded by an inversion. There's been a couple of cases, I think, where it's inverted and there hasn't been a recession, but most of the time when it inverts, there is a recession, and it's not unreasonable to expect a recession because it's been so long. The problem for Canada is the last couple of recessions that the U.S. had, we had a much milder version. In fact, the 2002 recession, we didn't even have a recession in Canada. And the U.S. had quite a severe one. And then 2009, the really big one, Canada had quite a mild one. So unfortunately, the odds are that the next recession will be more severe for Canada than it is for the U.S. Well, it'll probably be led by excessive private sector debt, which is, unlike government debt. The private sector can't just print more money to pay off their debts like the government sector can. So that's why it causes so much more angst when the private sector gets too heavily indebted.
Was it a mistake for Ottawa to overexpend by $8-9 billion a year more than their revenue during good times? Because if a recession comes along, they will have to spend money to keep things going.
Yeah, and that'll be many multiples of that. If you just on the real estate sector alone, if the real estate sector went from 8% down to 4% of GDP, something like that, to make up the difference, the government of the federal government would have to overspend by something like $50 billion, not 8 or 9 billion. And then the question becomes, well, politically, can they get away with that? So if they were smart enough, there's a fairly big if they were smart enough to know that they had to make up for the lack of demand in the private sector by spending that much, politically, they might not be allowed to. The opposition would say, "Oh no, you're going too deeply into debt." But then the problem is then the recession gets worse, and the government ends up spending that money anyway on unemployment insurance and bailing out some of the lenders that get into trouble, and bailing out CMHC, and there's just so many things that the government is on the hook for. In any case, so it's going to be very, very exciting times in the next year or two in Canada, and it's a really good time if people are thinking about taking on more debt. It's a much better time to be paying down debt rather than taking on new debt right now.
Also, too, if the banks run into trouble, Canada and the U.S. both have bail-in legislation where the depositors will be the first ones who have to pay the banks to keep them afloat.
Yeah, I know they've changed the rules to allow that, but I just have trouble envisioning. I mean, in the global financial crisis, they didn't even make people who were legally obligated, like debt holders, to pay their share. They basically the government stepped in and stopped that from happening because, for one thing, the pension plans owned a whole bunch of that debt. and it would have been devastating to the pensions of people if the pension plans had taken that loss. So, imagining the government standing by while the depositors were forced to pay the portion of the bank's debt, I just don't see it happening. If you go back a few decades, like about 100 years, there was a time with banks when the shareholders of the banks were required to pay the losses if the bank lost money. So there was recently, everything we've experienced is what they call limited liability shareholders, where you just buy your shares and that's it. You don't have any more liability. But prior to that, they actually could do a cash call on the shareholders of the bank to get them to throw money in. So I don't know. That's the other extreme. But I just can't see them going after the depositors. That would be, everybody will move to cryptocurrency and gold if they do that. I don't see that happening.
Hilliard, thank you so much for chatting with us.
Nice to talk to you again.
And don't forget Hilliard's new version of When the Bubble Burst, Surviving the Canadian Real Estate Crash comes out in a couple of days. Where can people get it?
They can get it on Amazon or at all the Chapters Indigo or any of the best bookstores close to them.
Hilliard, thanks again.
Thank you.
My guest has been Hilliard Macbeth, his website, macbethgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our popular YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.